There is a high degree of risk in trading. If you've traded for more than one day, you know that you can and will lose money. Only trade with money you can afford to lose. Hey everyone, today we're going to talk about how to create performance summaries that are good for nothing more than fooling people. So if you are a budding charlatan that wants to make money being dishonest, this would be a primer for you. Obviously, I don't advocate that. The purpose of this is if you're somebody that's receiving flyers from suspicious characters, you can understand exactly what's behind their deception. The other thing is it's a good technique for not fooling yourself in your own research. Okay. Bottom line is it's much easier to create really good-looking numbers than it is to create really good-looking numbers that are robust and pretend well for trading into the present and the future. Big difference. All right, so again, the advantage of understanding deceptive testing is you can avoid being victimized by unscrupulous vendor pitches, the kinds that we've all received, and also avoid inadvertently fooling yourself in your own testing. Briefly about me, been a member of the Chicago Board of Trade for over 29 years, spent some time in the pits, learned very quickly that that is not my forte. I was already a mechanical system developer when I bought my membership and started going down there. I was hoping to augment it with pit trading methodologies. Doesn't work for me, probably wouldn't work for most people. I'm not reactive, I'm not quick on my feet. Everything I do is set up an execution. Proactive, in other words, the basis of mechanical trading. But it wasn't a total loss. Got to meet a lot of very interesting people, maintained friendships with some of them. And roughly 15, 16 years ago, I decided it'd be nice to get an additional income stream. So I ventured into the world of advisory services, lecturing, which I did across the country and beyond. Wrote articles for all the major trading publications and wrote 4 books. The most recent, you see here, Beating the Financial Futures Market. Actually, that's not the most recent. It's the most recent full book, but I have just put out a 2017 almanac, sort of an upgrade on the book, which is of particular interest for people that ask, well, how have the systems been doing lately? Systems were developed prior to the 2006 publication, obviously. What the almanac traces is how they've done in the 11 years since. So both this book in its original form and the almanac has standalone information. Either one would be of value to somebody. All right, so charlatan pitches. This is very typical of what you get in the mail. My hypersonic Russell search and destroy system made $27,580 from January 2005 through the end of 2016 with a worst drawdown of $2,140. I always love this red type. You know, they're punching up, you know, the action verbs here. Things they really want to emphasize. Even more amazing is the system's 96.49% accuracy, 165 winners versus a scant 6 losers. Guess that'd be the real selling point here, right? Just give me a system that makes money all the time. So if you want to trade multiple contracts with far less risk than you're used to on a one lot, check this out. I should have put an exclamation mark at the end of that probably. I've isolated optimal times for blah, blah, yak, yak, and have targeted the ideal setups that yada, 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 quack, quack. Okay? So that was my little creation, but it wasn't pulled out of thin air. I achieved it through actual number crunching in TradeStation. And I came up with the actual numbers you just saw there, 27,580 dollar net profit, 96.49% accuracy, $2,140 worst drawdown, only 6 losers. All right, how did I do that? Is this photoshopped? No, it's an actual summary. And I did it simply the way that charlatans do it. I worked backward. Okay? Again, much easier to merely generate good-looking numbers than it is good-looking numbers that mean anything. So I'm going to take you through the process of how I did that. And I'm going to start with a legitimate system, not a great one, but a legitimate one. Okay, here's how it works. If the close is less than the 4-day average close, including the last bar, then buy tomorrow at the opening plus 75% of the average 3-day range on a stop. If the close is greater than the 4-day average close, then sell short tomorrow at the opening minus 75% of the average 3-day range on a stop. Set your profit target at $1,000. No stop losses. Okay, I take it back. System is almost legitimate, but that last point should show you there's something fishy going on. All right. But anyway, I'm going to take you through a few steps on getting those magic numbers we saw before. Step 1 is the only step that is semi-legitimate. Okay. Those rules I just showed you are perfectly compatible with prudent trading. Okay, it utilizes the 2 concepts that I know to be true about the index markets, the S&P, Dow, Russell, Midcap, NASDAQ, mainly that they revert to the mean frequently, which is why we want to be a buyer when we're under a 4-day average range and a seller when we're above it, but also when the momentum then reverts to your intended direction, it's frequently sufficient enough where you can profit on a fairly routine basis. All right. Now, okay, again, closest to legitimate the system that we have here, but not an example of a very good one. We would have lost $23,000 an open loss before we wound up making our $79.55. So, not great. So how do we make it great? Well, one way we can do it is we can scroll back on our trade by trades, which TradeStation and all, I would imagine, platforms will let you do. And we'll just isolate a particularly large losing trade here, in this case, this short. And let's come up with a rule that would eliminate this short. Whatever rule we come up with will probably change other trades as well. So it may be to our overall benefit to do it. It may not be, but we'll just keep looking until we find one that is. In this case, we add this qualifier that if we're going to take a short trade, the highest 2-day high minus the lowest 2-day low has to be less than 1.2 times the average 2-day range. Now in this case, that qualifier wouldn't be met because day 2 is a pretty short range, so that's going to make the average 2-day range really small. It's going to be smaller than 1.2 times this high minus this low. So keep your eye on the bouncing ball here on this short. That little thing, boom, eliminates it. It turns this slight losing long here into a winner, and it turns this big short loss into a small short loss. Now again, probably affected other trades down the line Maybe it improved us, maybe it didn't. Let's see. Okay, considerable improvement. We're now up to $34,000 profit. We've jumped from a percent profit, net profit as a percent of drawdown, from under 100% to 237. By the way, that figure is the net profit divided by the worst drawdown, which gives you a percentage that your account would have increased had you started with your worst drawdown. Okay? I don't want to emphasize that too much in this particular talk, since, you know, we're looking at a charlatan system anyway. Usually I would stress that as we're looking at systems that you would want to consider using. Hopefully, though, this information on what to avoid is just as beneficial to you. Okay. So, we had one added filter in there. Let's add a second one, this time to the long side. And it says that in order to take a long trade, the high minus the open has got to be greater than 10% of the range. This is a two-part qualifier. And the close has got to be greater than the previous bar low. Okay, so I came up with that to eliminate this horrific long position. Close has got to be the second part of that long qualifier. Close has got to be higher than the previous low. I think it's previous bar low. I'm right. Okay. Obviously, this close is lower than that low, so presto changeo, we would lose this long. And we'd have a lot of territory where we're not in the market at all. But the overall net result is further improvement. Greater net profit still, greater net profit as a percent of drawdown, which I usually refer to as the return on account. We've got our percent profit jacked up very nicely. Our average profit per trade is up to $230. I'm going to stress this again in case anybody's forgetting. This is a charlatan approach. It's making the numbers look good. It's not doing anything beyond that. This is how they get you. All right. Let's add a third and final qualifier that's calendar related. We will not take any long trades on Thursday or any time in April. We will not take any short trades on Wednesday or any time in March. Here's your third filter. Return on account jumps another 100 or so. All right. But how did we get those ultimate figures? That 96% with only the 6 losers. Very simple. We're going to take that $1,000 profit target and we're going to move it down to $200. This is a very frequent technique used by vendors that want to show you a high percentage profitability. If you take profits really quickly, obviously you're going to get more of them. Okay? Does not mean your overall result is going to improve, though. Very frequently, it's going to be just the opposite effect. Because remember your adage in Trading 101. Let your profits run, cut your losses short. But here's what happens when we take those quick $200 profits. By the way, we let those losses run against us. You've got something that's more than 10 times. If you hit one of those losses, you know, you might wind up having a bailout with 10 more winners. That's not a good place to be. As my late trading partner used to say, this idea will work until it doesn't. And in this case, probably day one, it'll stop working because we've cheated in getting these numbers. All right. I hope you all understand that. So your takeaways, you can make your numbers do pretty much anything. Famous system developer Larry Williams had a great quote. He said, numbers are like prisoners of war. You beat them enough, they'll confess to anything. By working backwards and eliminating non-conforming data, in other words, losing trades, you can make your numbers better. You add as many rules as needed to eliminate your worst trades. And you should be able to spot a charlatan system using that old adage, if it's too good to be true, it probably is. Okay? Best traders in the world are not right much more often than they're wrong. They're successful because they manage money effectively. It's what they do with their trades after they get into them, much more than some sort of magic entry signal. You've got to believe that. If you're seeing results of 85, 90, 95%, throw it in the garbage where it belongs. All right? You should always be skeptical and always willing to do all your own work anyway. And again, what we just saw here is something you have to be on guard for in your own trading, your own research, because even though we've demonstrated something that's really silly, sometimes mistakes are much more subtle, much harder to pick up. So you've always got to be aware that good-looking numbers come very easily. Robust numbers are much harder to come by. All right. So I hope you can utilize what you've just heard, take something big out of this in your own research, and be vigilant. And thanks very much for joining me.